Financial. We are not here to sell you on the latest market hype. Our mission is to help you forge a stronger portfolio by putting the market's biggest names under the microscope, by stress testing them. And today, we're putting Regeneron in the crucible. They just dropped their Q4 2025 earnings report, and honestly, the headlines are all over the map. Some people see a biopharma juggernaut that can't be stopped. Others see a giant that's starting to stumble. We're going to cut right through all that noise, put their numbers on the anvil, and see what this company is really made of. Let's get to work. So this really brings us to the core question, the central conflict of our entire analysis today. When you look at Regeneron, ticker REGN, what are you actually seeing? Are you looking at a biopharmaceutical fortress, a company with, impenetrable walls, a deep financial moat, and a war chest that's ready for any battle the market throws at it? Or is this a crumbling empire? Is it a beautiful facade that's hiding some deep structural weaknesses? Are the key pillars of its revenue beginning to erode right before our very eyes? That is the conflict we are digging into today. It's the bull case versus the bear case, plain and simple. And the answer is going to determine whether this stock is a genuine opportunity or if it's a trap waiting to be sprung. Okay, let's dive right in, and we're going to start with the bull case. And, on the surface, the bulls have a lot to be excited about. This is the story that management wants you to see, the one they're shouting from the rooftops. It's a story of a powerful, high-performance engine firing on all cylinders, and it's all driven by a portfolio of absolute blockbuster drugs. This right here is the foundation of the fortress. So let's begin with the top-line number, the big one everyone looks at first, revenue. The market, Wall Street, they were looking for about $3.79 billion for the fourth quarter. Regeneron came in and posted $3.9 billion. That's a solid beat. Now, is it a massive, earth-shattering number that's going to double the stock overnight? No, but it signals strength. It shows that even in a tough, competitive market, they exceeded expectations. This tells you that despite some pretty serious headwinds, and trust me, we will get to those, the company is still finding ways to generate some serious cash flow. Think of this as the first layer of armor on the fortress, and from this angle, it looks pretty solid. And this is where that revenue is coming from. See, you're not looking at a one-trick pony here. This is a portfolio of absolute titans. You've got the Eylea franchise, which for years has been the undisputed #1 branded treatment in its category for certain eye diseases. Then you've got Libtayo, a truly dominant force in treating specific types of skin cancers. And then there's the crown jewel, Dupixent. It is the #1 prescribed biologic for a whole range of type 2 inflammatory diseases. These aren't just successful drugs, these are category-defining assets. These are the products that built this company into the giant that it is today. This is the core of their power. Right, and I want to pause on this quote from the CEO, Leonard Schleifer, for a second, because this isn't just fluffy corporate speak. You have to pay close attention to the language he's using. The most widely used, innovative, branded antibody medicine, over 1.4 million patients. This single statement is the key to the entire bull thesis for Regeneron right now. Because while other parts of the business might be showing some serious wear and tear, Dupixent is not just a pillar holding things up. It's a hyper-growth engine that is being asked to carry an absolutely immense load. The company's future, at least in the short to medium term, rests squarely on the shoulders of this one single drug. And the numbers? Well, the numbers tell an even more powerful story. Just look at this growth. It is absolutely staggering. Dupixent's global net sales, which by the way are recorded by their partner Sanofi, jumped 34% year over year in the fourth quarter. We're talking about a multi-billion-dollar product that is somehow still growing at the pace of a scrappy startup. This isn't just growth, it's a full-blown explosion. This is the cash flow that funds everything else. It funds the R&D, it funds the share buybacks, it funds the expansion. Dupixent is the engine that is driving this entire machine forward. And right now, that engine is roaring. If you're a bull on this stock, this chart right here is your entire thesis. All right, hold on a minute. That's a great story. It's a powerful story, I'll give you that. But here at Iron Financial, we don't just admire the shiny exterior. We take a hammer to the foundation and we go looking for weaknesses. A 34% growth rate in one drug is phenomenal. Absolutely. But what good is it if the rest of the fortress is starting to rot from the inside out? Is Dupixent's incredible growth just papering over some really serious cracks in the armor? Let's stop looking at the pretty headlines and start digging into the fine print, because what you find in there, it's a lot more concerning. So here's the crucial point. That top-line revenue beat, that $3.9 billion figure, it's hiding a very ugly truth. A company of this size, it has to rely on multiple pillars of strength to stand tall. And what this latest earnings report shows is that one of its biggest, most important pillars, frankly, the one that built the company in the first place, isn't just weakening, it's actively crumbling. I'm talking about the Eylea franchise. For years, this was the undisputed cash cow. Now, it's the biggest source of concern for any serious investor. This is the stress fracture we need to examine very, very closely. And this chart just says it all. This is not a small dip. This is not some minor setback that they're going to brush off next quarter. This is a collapse. Total U.S. sales for the entire Eylea franchise, and that includes the old version and the new one, they plummeted 28% year over year. Think about that. Down from nearly $1.5 billion in the fourth quarter of 2024 to just over $1 billion in the fourth quarter of 2025. That's a loss of over $400 million in revenue from a single product line in a single quarter. And this isn't happening in a vacuum. This is the direct result of intense competitive pressure, especially from rivals like Roche's drug Vabysmo, which is just aggressively eating into Eylea's market share. That is a massive hole to fill, even for a drug as powerful as Dupixent. This right here is the central problem for Regeneron. Now, management, they'll tell you this is all just part of a planned transition. They'll point to the left side of this chart and say, look, our new Eylea HD version is growing like a weed. Sales are up 66%. And you know what? That's true, it is. But what they really don't want you to focus on is the right side of the chart. Sales of the original Eylea are down a catastrophic 52%. The new drug's growth is nowhere near enough to offset the old drug's collapse. It's simple math. For every new dollar they bring in from Eylea HD, they're losing far, far more from the original product. This is not a successful transition, not by a long shot. It's a net loss of hundreds of millions of dollars for the franchise. The math is brutal and it's completely undeniable. And believe me, the problems don't stop with Eylea. When you zoom out and look at the company's overall financial health through the lens of a skeptic, even more red flags start to pop up. The Guru Focus analysis points out several big ones. First, their operating margin has been steadily declining for 5 years. That means they're becoming less profitable on their core business operations. That's a bad trend. Second, just look at the valuation. A price-to-earnings ratio that's hovering near its 1-year high and a price-to-sales ratio of almost 6 tells you one thing. This stock is priced for perfection. It is expensive. You are paying a premium valuation for a company whose margins are shrinking and whose former star drug is an absolute freefall. And to top it all off, you've seen recent insider selling. The people who know the company best are cashing out their chips. These are not signs of a healthy, undervalued asset. These are warning signs blinking red. Warning signs? Yes, acknowledged. We see them too. But let's not mistake a challenging renovation project for a complete demolition. The skeptic is absolutely right. The Eylea franchise is under immense pressure. But that is precisely why you build a fortress in the first place. You don't build it for sunny days and calm seas. You build it to withstand a siege. And when you look past the income statement and into Regeneron's balance sheet, what you find isn't a crumbling empire at all. You find a financial fortress forged from years of disciplined financial management. They knew this day was coming, and they have been preparing for it. These numbers right here directly counter the narrative of a company in distress. This is the steel and concrete infrastructure of the fortress. Let's look at the current ratio, over 4. That means they have 4 times more current assets than current liabilities. That is incredibly strong liquidity. It gives them a massive cushion to operate. Now look at the debt-to-equity ratio, just 0.09. That's next to nothing. This company is not burdened by debt, which is a rare and incredibly powerful position to be in, especially in this industry. And finally, the Altman Z-score of 7.54 indicates an extremely low risk of bankruptcy. These are not the metrics of a company on the ropes. These are the metrics of a company with a rock-solid financial foundation, built to weather exactly this kind of storm. And let's circle back to that declining operating margin. Yes, it's been under pressure, that's a fact, but we have to maintain perspective here. The company's net margin is still over 32%. Let me just repeat that. For every single dollar in revenue that comes in the door, they keep 32 cents in pure profit. This is an incredibly profitable enterprise, even with all these headwinds. They are a cash-generating machine. So while the rate of profitability might have slowed down a bit, the sheer volume of cash being generated is still immense. This profitability is the war chest. It's what funds their entire strategy for the future. It is the fuel for the rebuild. This number right here, it just perfectly demonstrates their financial discipline. 90.44 times interest coverage. In plain English, this means their earnings can cover their interest payments on debt more than 90 times over. It's almost a meaningless number because their debt is so low to begin with. But the crucial point is this. This company is a master of its own financial destiny. They are not beholden to banks, they are not beholden to lenders, they have the flexibility, they have the cash, and they have the stability to make aggressive, long-term strategic decisions without ever having to worry about short-term financial pressures. This is what a fortress looks like on a balance sheet. So the real question then becomes, what do you do when you have a fortress and a massive war chest, but one of your key territories, Eylea, is under attack? Well, you don't panic. You execute the plan you've been preparing for years. You use that incredible financial strength to fund a massive strategic overhaul. This isn't about patching a few holes in the wall. This is about building the next generation of the company, a completely new foundation that's designed for decades of future growth, brick by expensive brick. So let's take a look at how this plan is actually structured. This is management's official blueprint, coming directly from their own investor presentations. It lays out exactly how they plan to deploy all that capital we were just talking about. It's not a mystery, it's not a secret, it's a clear, disciplined, three-pronged strategy that is designed specifically to lay the foundation for the next wave of innovation and completely rebuild their growth profile for the long term. This is the plan to move beyond the Eylea problem for good. So let's break down this blueprint. There are three core pillars, three main priorities. First, and this is the most important one, they are pouring money back into the business, into internal research and development. This is all about building from within, creating their own future. Second, they're using their cash to go out and acquire external innovation through business development. Licensing deals, collaborations, maybe even acquisitions. They're essentially buying what they can't build fast enough themselves. And third, they are rewarding shareholders for their patience through significant share repurchases. It's a very balanced approach. Build, buy, and reward. Okay, now let's talk about the sheer scale of this internal investment because the numbers here are genuinely staggering. This is the heavy lifting part of the plan. They're projecting around $6 billion in R&D spending in the year 2026 alone. On top of that, they've already committed over $7 billion to expand their manufacturing and R&D infrastructure right here in the US. And just recently, they announced another $2 billion for a brand new facility up in New York. If you add it all up, we're talking about a commitment of over $15 billion to internal growth projects. This is not the behavior of a company that is scared or retrenching. This is a company going on the offensive, leveraging its financial strength to build its own future. And this, right here, is the potential payoff. This is what all that spending is designed to achieve. The goal is to build one of the deepest, most diverse pipelines in the entire biotech industry. They are aiming for roughly 45 different clinical candidates. And these aren't small market niche drugs. We're talking about next-generation antibody treatments for solid tumors, novel genetic medicines for rare diseases, and potential blockbusters in massive markets like obesity and cardiovascular disease. These programs combined are targeting a global market opportunity of roughly $200 billion a year by 2030. The strategy couldn't be clearer. Diversify away from Eylea by creating a dozen potential new blockbusters. It is ambitious, it's incredibly expensive, but it is a clear plan to replace and, they hope, dramatically exceed the revenue that's being lost today. Okay, so we've seen both sides of the coin. We've laid out the bull case, the fortress built on Dupixent's incredible growth and a rock-solid balance sheet. And we've stress-tested the bear case, the crumbling Eylea franchise, the margin pressure, and that premium valuation. Now, it's time to bring it all together. It's time to hammer this out and forge a verdict. What's the final call? Is Regeneron an opportunity to buy into a long-term rebuild, or is it a trap for investors who are paying way too much for a company in a very painful transition? So here are the two competing narratives, laid out side by side. The bull case is simple. You are buying a fortress. Dupixent is an unstoppable growth engine that's generating an enormous amount of cash. The balance sheet is one of the strongest you will find in the entire industry. And management is using that strength to aggressively invest in a pipeline that could create massive future value. The bear case, on the other hand, is that you're paying a premium price to live through a very messy and very expensive renovation project. The Eylea erosion is real, it's deep, and it's painful. The margins are being squeezed, and the stock's high price means that if there are any delays, any setbacks, any failures in that massive pipeline, there is a long, long way for the stock to fall. There is simply no room for error in their execution. And so the entire argument, the crucial point, it all comes down to this quote from the CFO, Christopher Fedimore. He lays out the strategy perfectly. Invest internally, look for external opportunities to buy, and reward shareholders. The entire investment thesis for Regeneron today, right now, hinges on one single thing. Your belief, your faith in management's ability to actually execute this plan. Do you believe they can spend tens of billions of dollars effectively and efficiently? Do you believe their scientists can deliver the next generation of blockbuster drugs from that 45 candidate pipeline? And do you believe they can do it all before the Eylea decline becomes too much for even the mighty Dupixent to overcome? Ultimately, that's the question you have to answer for yourself as an investor. The blueprint for growth is on the table. It's clear for everyone to see. The financial foundation to support it is solid as a rock. The capital is being deployed as we speak. But a blueprint is just a piece of paper. The fortress of the future still needs to be built, and that kind of construction is always fraught with risk. So the question is management's execution strong enough to complete the job and deliver on that $200 billion promise? That is the stress test for your own portfolio. Thanks for joining us on Iron Financial.